So, welcome everyone to the launch of OmniScience PMS. I am Dr. Vikas Gupta, CIO, Chief Investment Strategist and CEO of OmniScience Capital. And together with me, Mr. Ashwini Shami, who is the President and Chief Portfolio Manager, leading the PMS platform for OmniScience. So we'll be sharing our launch with you and explaining the philosophy and the logic behind it. Uh, so let me get started with this. As you can see, our whole strategy is based on OmniScience Capital, right hand top side, Science of Alpha from Safety. And even in the title, you can see Scientific Investing Framework, OmniScience PMS, Beyond Buffett, Beta, and Billions. Chase for safety is hunt for true alpha. So this is our way of looking at things, is that safety and alpha go hand in hand. And there is something called true alpha, which also we'll talk about. In our vision, why we are launching, why you need one more PMS manager, is we want to bring the discipline of rational allocation of capital. So when you come to equity markets, all kinds of things people do, but there is a rational way of allocating capital. That is the purpose of having equity investments. And that is what we want to encourage. And you will see how we do that. This is the main thing, which is the scientific investing ecosystem. So scientific investors, scientific partners, scientific managers, all three put together, when all three come together, you have a scientific investing ecosystem. And we think that most investors will not be suitable for this. Most partners will not be suitable. Only a very limited number of clients, probably less than 10% of the total market participants, they can understand the scientific investing way of things and they are eligible. They should be partnering here. Same way from the partner point of view. People who understand, so things like long-term investing, 3 to 5 year plus, that markets go up and down, that when you enter the market and you've invested 100 rupees, it will look like 50 rupees, 70 rupees at some point of time because markets go up and down. And the discipline that when it goes down, actually to invest more. So that's the kind of investors we're talking about. That's the kind of partners we're talking about. And people who understand that revenues, earnings, cash flows, profits, these are the things which is what you're investing in rather than a stock price. Okay. So when markets go up and down through bear markets and things like that, the revenues are not really going, the earnings of the companies are not going down. So those are the kind of people we are talking about when we say scientific investors. So our belief is that when performance leads, the ecosystem wins. So when performance is there, the everyone in the ecosystem, all the participants, which means investors, partners, and the managers, everyone wins. So that is our focus. Now the question is, how do you get performance? Okay, so performance, people confuse performance with returns. Returns are not performance. Performance is returns adjusted for risk. Okay, so that is true alpha, and true alpha is performance. And the typical understanding is either you take low risk and you will have low returns, or you take high risk and you will have high returns. But then there is, you are just getting higher returns because you took the risk. And in a particular cycle, the risk will be favorable. So the returns come to you. And in the next cycle, the risk could be against you and you have a huge loss. So the high risk, high return doesn't give you high returns in the long term. So that is something which you need to understand. And that's why you need higher return, not from higher risk. Okay. So many investors, clients, distributors, partners, managers don't realize in the industry. And that is what we are trying to portray, that you need to have true alpha. That is performance. Now the question is true alpha possible? And for this answer, we look at the Nobel Prize winners from 2013. There were actually three Nobel Prizes given in 2013 for economics. And one is a mathematician, which I have not shown here, but two are from finance. And Eugene Fama is saying true alpha is not possible. In the same year, they're giving to Robert Schiller, who's saying true alpha is possible. And we are saying Fama is right, that in active management like PMS, AIF, MF, actually smart beta factors like quality, value, size, growth, momentum, etc., they masquerade as alpha. So that is not true alpha. It is actually taking higher risk, but it is masquerading as alpha. And on the other hand, we are also saying Schiller is right. We have done an internal analysis on our uh, 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 investment strategy returns. And we have seen, including our India strategy as well as US, and we have seen that true alpha is possible. So we have applied, actually, funnily, we have applied Pharma's approach. So these are the Pharma French three-factor model, Pharma French five-factor model, etc. And we have proven Schiller is right. So true alpha is possible. Fake alpha is also possible when we say Pharma is right, right? The smart beta things. So performance is equal to true alpha, low risk, high return. Now, to understand how this is possible and why we are the people to do it, is you have to understand the Omni DNA. So the team is there with decades of research-led investing experience, and there are a lot of talented people in the market. But that itself is good. But philosophy is the main thing. And the philosophy, there are three parts. One is the basic client that comes first. Okay. Second is skin in the game, that whatever we are asking a client to invest in, we are fully invested in that. And then comes the science of alpha from safety, the investment philosophy. Okay. So these are the three pillars on which our philosophy rests. The differentiator is the research framework, the proprietary scientific investing framework, which we have been using for a decade now or more, and identifying hidden growth factors. Okay. So these are the two parts to the generating true alpha and discovering unearthed growth factors. And all of this then results, all that results in a performance where we are chasing safety to hunt for alpha. Okay. So that is a result of doing all this. So these are our scientific managers. As you can see, the three core team members, Varun is bringing the quant and research skills. Ashwini Shami is bringing in the institutional quality practices from Wall Street. And I am bringing the scientific mindset and as well as the philosophy, which is based on the foundation is the Warren Buffett, his guru, Ben Graham, people like Peter Lynch. And there are hundreds of these investment managers over last 100 plus years, which we have gone through and we've applied over decades. And this is the result we have, which is scientific investing framework. So let me summarize two things here. There is an Omni insight here, which is most market participants chase alpha but get risks. So while trying to chase high returns, you end up with risks. While one could chase safety and get alpha. This is our insight, that you could actually chase safety and you will end up with alpha. And to summarize that, we have an Omni mantra which you can remember easily: chase safety, get alpha. Okay. Today, I'll not get into this. We have many videos and many events when we have discussed the scientific investing framework. So very, very briefly, I'll explain that we take the full market. Let's say we are doing Omni Supernormal, which is our flexi cap strategy for India. Then we would take the top, everything above 1,000 crore intrinsic value, and broadly you can say market cap. So there are 1,500 odd stocks there. And from that, we start cleaning up the universe. First, we take out capital destroyers with weak balance sheets, loss-making companies, etc. All weak things are taken out here. Second is the capital eroders, where the companies which don't have competitive advantages, and the longer you stay with them, they are destroying shareholder capital, right? Even though they are booking profits, they're showing growth, all those things are there. Despite that, actually they are diluting your value. So we take out the capital eroders. And now we are left with all good to great companies with strong balance sheets. But there is a third risk factor, which is capital imploders, where a good company or a great company is priced like multiple times of its actual value. Okay. And so those overvalued companies we take out. These are the capital imploders. And then we are left with what we call capital multipliers. And then from those companies, we do a deep dive to find out opportunities which are below the radar growth opportunities, which the market, Mr. Market, has not yet realized, right? But these are long-term growth factors. We also call them inevitables. You will see them as omni inevitables. So we have done the analysis for 10 years over the 10 billion AUM, assets under advice. And what we have shown, I cannot share the numbers here from publicly. I don't want to share the data here. But basically, we have done that analysis, and one-on-one we can discuss, whoever needs to understand better. But basically, there is the benchmark return, there is the portfolio return. First criteria normally is that are you generating better than the benchmark? Second point is on a CAPM, capital asset pricing model, are you generating alpha? Or you're just taking more volatile stocks and that's why they will generate more excess return, that is high risk, high return, right? And then there are these 3-factor, 4-factor, 5-factor models, which is the size, value, quality, growth, and market. And we will talk more about it. So to our satisfaction, both the India as well as the US, which both have nearly 8 to 9 years of track record, we have seen and we have analyzed and we have seen that it is that true alpha is possible. Okay. Now you have to be careful in the PMS world or even MF world. Lot of fund managers, you would all be familiar, anyone who's doing for mutual funds or PMS for a long time, that lot of managers talk about quality, a lot of them talk about value, size, growth, momentum. Most of these are smart beta masquerading as alpha. Okay. So easily replicable, but most people do not realize, even the fund manager doesn't realize that what they're doing is actually just smart beta. They're not doing much value beyond that. Now, we also did a lot of analysis of our scientific investing strategies. And we came up with these 3-4 things which will help you understand how this the portfolio is going to work. So the typical, we have about 25 to 30 stocks in the portfolio, roughly equal weighted. So 3 point something to 4%, right? And typical holding period is 3 years. This is the actual analysis of all the entry and exits. And secondly, where is the alpha coming from? So we saw that alpha is coming from, theoretically, it can come from 3 sources. It is yield plus growth plus re-rating. That is the total return is coming from that. But in our case, what we have seen is that primary driver is re-rating. Which is 70 to 75% of the returns are coming from that. And 25-30% returns are coming from the earnings growth. Second point, and the holding period typically for a stock is about 3 years. Second thing you have to understand is how it will behave in the market fluctuations. And what we have seen, this is the past analysis. Now, again, we know that past and future can be different. But in the past long period of multiple cycles, including COVID and interest rate hikes twice by the Fed, US Fed, we have seen that our upside capture ratio, when market goes up, we are doing twice better than the market. And when market goes down, we are at 90% of market. So it's not that we will not go down with market, but according to the stats, it goes down less. And according to when market goes up, the portfolio goes up more. But I would say you be prepared for market going down and us going down more also. That shouldn't matter as long as in the long run, it is risk adjusted better performance. Now, people think that true alpha is not possible, or it's possible only in unknown names, very small cap companies, micro caps and all that. So I want to show you one case which will tell you what happens. So 2016, Apple at that time also was one of the largest company in the world with $500 billion market cap. So no company had reached 500 billion plus at that time. Apple was at 520 billion in 2016 market cap with net cash of $160 billion. So you are left with actually enterprise value you are paying is only 360 billion and the PAT was 53 billion. So MCAP to earnings, MCAP to PAT, PE was 10 on the face of it. But otherwise, you could even say that it was 7, right? Adjusted for cash. And everyone was negative on this company because Steve Jobs had just expired in 2011. It was 4 or 5 years. No new products have come out. There was a little bit of a revenue drop. And people were saying that, okay, the story for Apple is over, right? And then there are like 50 odd, all the best of the best analysts on Wall Street and all the $1 trillion fund managers investing in it. But people said this is over, right? And that is why it was. What did we see? So the Omni view, it is captured in the article in the street.com, uh, is given that. So we saw that there is not only 50 billion of earnings PAT, but the free cash flow is even higher at 70 billion. And so the EV to FCF, which is similar to PE, is just 5. Second point, then this was known to everyone because company announced it publicly that they will do a buyback of $250 billion in the next 2 years. So you're paying 520 billion, 250 is coming back to you in next 2 years. So 50% is just coming back to you in 2 years. Third point is 1 billion installed base. So that till at that point of time, people had some Apple device in the market, which was 1 billion. And the typical replacement cycle is 4 years. So around 250 million devices were going to be replaced every year. Okay. And that would tell you the predictability of the sales and profits very easily. So the base case sales was not a worry. There was no revenue shrinkage expected. Next thing was that where is the new product going to come from? And so we looked at the R&D. R&D was $10 billion per year. Okay. And if you put 4 or 5 years of R&D together, that was around $50 billion. And how much will that add to the future growth? So to estimate that, we went to look at the whole US venture capital AUM. And that was about $300 billion in hundreds of VC firms, right? And they are expecting about 1,000 unicorns to come out of this. So if I take that and just 15% of all US venture capital in the world is concentrated in one company, Apple, right? And they're putting 50 billion. So they are expecting 150 unicorns coming out of it. And the average unicorn would be, let's say, at $2 billion. The cutoff is 1. So the average would be, let's say, around 2 billion. That would add 300 billion more to the valuation, right? So this is how we have seen. And now, nearly 9 years later, it is about what? 8 times, about $4 trillion now. Apple, and still one of the largest companies. I think just Nvidia is above it. So you can see in the world's largest company, there is so much mispricing that it can be 7 to 8 times in less than 10 years. That's extraordinary thing. And that proves that true alpha is possible. That comes out of two things. One is superior analytics. Everyone has the same information today in the age of internet and chat GPT. You have all of that information. But better analytics, superior analytics. And second part is temporal arbitrage, that we are willing to look for a 3 year horizon rather than next quarter, what is going to happen. Same thing, it's not just one case. Another case is Netflix. Again, very, very popular company. Again, we were able to get it at a significant discount to its intrinsic value because Mr. Market was mispricing. Same thing applied to Meta, which is the owner of Facebook and Instagram and WhatsApp, right? So all these cases I'm showing you just to tell you that even in the most well-known companies, there is mispricing. You don't have to look for hidden gems in IPOs, SMEs, and microcaps necessarily. So now I'll hand it over to my colleague Ashwini, and he'll explain the scientific investing, how it anticipates the inevitables.
Great. Thanks, Vikas. And yeah, so Vikas did mention inevitables and how we have exhibited that in the global markets. And similarly, I have few examples from the Indian markets that first the concept like inevitables essentially is, which are the forward looking basis, the sectors or, the industries that are going to create much more economic activities in terms of what they are currently doing. And as an investment opportunity, whether they are from an investment point of view, with if you're looking at mispricing or at having a larger size in the whole pie, this is all is covered under inevitables. But before I get into what we are offering currently, but let's just look at few examples from the past. And yes, so this is around 2018 when digital transformation was a theme which was uh, just coming up. It was not that popular, and we had seen the whole Indian, kind of research ecosystem was negative on the IT as a space, and obviously they were looking at the past where these business was struggling to grow, maybe at mid single digit kind of growth numbers for most of the IT players. What we saw differently was the whole the cloud migration, the digital services growing at somewhere around 30, 40, even 50% for certain businesses. And you could just split the whole company into a legacy business and a fast growing digital business. And digital business were already, let's say, 25 to 30% of the total business. And if you just do a as some of the parts valuation, you would see the whole company is actually available quite cheap. And we had anticipated that once this digital part becomes grows and becomes more than 50%, the overall company growth will also come into double digits somewhere around 2020 2021. And that's what happened. And we saw the whole sector got re-rated. And while the earnings were still kind of 11-12% growth, but the kind of returns that we generated was significant from the re-rating point of view. So this was digital transformation. uh, the next one is, we spotted defense as a growth vector way back when everyone started talking about 2019 itself, or 19 or 20. We had some of the defense companies in the FlexiGap portfolio. And again, here, the brush was used that okay, all PSUs are capital destroying, so it's not a wise idea to invest. What we saw is companies with 20-25% kind of compounding on earnings on and fat order books and very very efficient capital efficiency that these were exhibiting. And we launched this dedicated strategy on a platform called Small Case. And almost after a year, the index, first index on defense came. Uh, After 2.5 years, the first fund on the, which made it kind of investable for broader audience came. And after 3.5 years, many more funds came, to give you that kind of exposure. See, but what has happened during this time frame when we launched the defense strategy, the P's of these companies were, in many cases single digit or maybe, low double digits. But by the time index came, the P was already beyond 20. By the time first fund came, the P was around 30. And by the time where many other funds came to gather assets on this particular theme, which was already, kind of quite popular, the index P was more than 50, 50 or 60. So alpha opportunity, while it remains a very high growth vector because the growth outlook is very, very strong, but the alpha opportunity is, significantly diminished in terms of now the re-rating potential is practically not there. So that's another example from how we spot inevitables. And the third example that I have is from the railway infrastructure space. Right, this was again mispriced broadly because it was the predominantly the companies were under the public sector enterprises. And there seemed to be they didn't have a good capital multiplication or multiplier branding. But you can look at the screen and see, how the re-rating element has, generated significant alpha again for investors in this growth sector that we have been again offering since 2021. So this is how, what Vikas is trying to say, that, without taking, just smart beta kind of risk factors and tilting your portfolio to one of these, styles, the essentially the returns are generated significantly by the re-rating component, which generates true alpha. Uh, Now, for the last 8+ years or nearly a decade of our existence, you know we have shown that we lead and the market follows. There have been multiple such examples in terms of, whether it is our flexi cap strategy, the DX, the multi cap in the US, the defense. I know I talked about few, but there have been other like power sector or capital enablers. So we have exhibited that this is kind of a mindset, and the scientific ecosystem that we're trying to build is, working very, very strongly. We are happy, and this is a very nice feeling, to be able to help so many clients and so many partners to achieve more than what could have been without they would have done without OmniScience. And this is these are some of the milestones. Obviously there's a long way to go, but our association, as a team, as a scientific investing team, as we would like to call ourselves, is more than a decade old. And obviously the scientific investing philosophy and framework has at least 2 to 3 decades of making. And in the last 8+ years, we have been able to come up with various structures, various strategies, which have generated significant amount of alpha. And today we are here to talk about our PMS offering, and in terms of what we are bringing to the table, what is the differentiation in terms of what is the current landscape, and so on. So, what we are launching today are three separate categories of strategies for investors to look at. There is Omni Crest, there is Omni Inevitables, and Omni Institutionals. Right? So, Omni Crest is the flagship, or kind of fundamental allocation that investors can look at. This is the hunt of for true alpha across market capitalization. So obviously there are specific strategies, which can help investors take pure play exposure to, say, only large caps or only mid caps or only small caps, or a combination of that. And obviously then there are flexi cap slash multi cap offering, which looks at the full market, all companies more than 1,000 crore of market capitalization, and identify wherever the true alpha is hiding. So this is a fundamental allocation, and one of the most important. Anyone who's starting with us is recommended to get start with Omni Crest, and there also the FlexiCap offering. One innovation that we are doing is through Omni Inevitables as a product category, which is something has not evolved significantly, especially under the PMS space. This is what as I said, forward-looking sectors and industries, right? In the next 10 years, when India, is growing and becoming, let's say, a $10 trillion economy, what are the sectors which are going to be defining, the full market? And it would probably a great idea to take exposure today and take the full juice out of when the whole re-rating mispricing gets evolved. And we have seen in the past that that can happen in the largest company in the world like Apple, or it can happen in a maybe a unknown or a sector which is being dismissed altogether, right? So that is something that we keep our eye on very closely, and spot these inevitables, and come to you and bring them to you in the form of various strategies. So we have 8 different strategies when it comes to inevitables. And obviously on one-on-one basis, or on our website, all these details are available. There's limited time to go into all these strategies separately, but we will be communicating, about these various strategies and various portfolios separately, and so as we go along. The third category is the Omni Institutional, which is specifically designed for family offices and institutional investors who would have needs about, where you need to think about how to manage the liquidity of the portfolios, how to manage the diversification across asset classes, and include something like a global equity allocation or something which is not there in India per se, and also create and try and create a more stable portfolio, so that where, in certain cases where the focus or orientation is not completely on, highest alpha, but alpha which is achieved in a more stable manner. These are the strategies which will be available on the Omni Institutional category. uh, so moving on, I will just talk very briefly about the our flagship, which is the Supernormal India. Obviously, as being a PMS product, the minimum investment is 50 lakh rupees. And here, the flexibility that we get is that we get to look at the full Indian market. So we look at all companies at more than 1,000 crore market cap. There are currently 1,400 such stocks, and our focus is, apply the scientific investing process to the that universe of 1,400 stocks, and identify, first eliminate, where fundamental risks are available, right, or are there. So we don't want to, we have a very wide universe to pick stocks from, and what we essentially want is like a 25-30 stock portfolio. So we are, uh, extreme options in terms of being, very very critical in terms of we don't want any kind of fundamental risk to come in. So the scientific investing process first goes through the full market, eliminates all fundamental risk or mitigates those things. And then the second step is to, focus on multiple growth vectors or multiple inevitables in that portfolio, and come up with a diversified pool of 7 to 8 different growth vectors. And let's say, as I speak currently, you can see that the current portfolio has, banking and financial services as one growth factor, power is another growth factor, construction engineering or EPC space is there, freight, logistics, housing finance. So these are some of the growth vectors which are significantly mispriced, while the growth outlook for them is pretty strong. And fundamentally they are all, strong balance sheet companies. Their margin profiles are very strong, their capital efficiency or capital allocation strategy has remained very very strong. So this is what, in a nutshell, that Omni Supernormal India investor gets. If you look at, focus on the table that is given, which is valuations versus fundamental, you will see that on the fundamental side, this supernormal portfolio is, either at par with the market or significantly better in certain counts. uh, However, on the valuation front, if you see, while the market, the universe from which we are selecting is around 25 PE, while we have been able to carve out a portfolio at a discount of less than 12 PE, right? So that is the power of, the whole scientific investing process, and that is how, the more than two-third returns come from the re-rating component, right? Because we are focusing on fundamentally strong companies, companies which are growing maybe faster than, the broader economy, and they are mispriced. So as soon as Mr. Market realizes this mispricing, and whether that could be few quarters to maybe few years at times, uh, significant amount of returns can be generated by, right? So overall, not spending time on overall, India growth story, I think we all are, quite comfortable on that front. Yesterday, the GDP numbers came again reinforcing that, India can grow at 8% plus kind of real returns for a long period of time, and we are looking at something like a 10 trillion number by 2035. And the consumer base is evolving or rather exploding. There are multiple opportunities on services manufacturing that are coming up. There is a huge capital expenditure exercise which is going on and will continue to hold, so making the financial services space quite attractive. And this all put together in a space where globally, everything is in a, kind of a reorganizing and dislocating from, how the global economic ecosystem has been working, which is also adding a spin, like a favorable tailwind to Indian economy. So I think we have a very one of the best backdrop to, be a equity investors. And over that, if you have a alpha generating portfolio or strategy, then that just adds to the whole thing. Yeah. So with this, I'll just, I'll welcome Vikas back to summarize our discussion today, and also maybe, on a couple of slides.
Perfect. Thanks
Yeah.
a lot, Ashwini. And so this is, we will close with this. And I just want to contrast on this chart, which is on the left side, you're seeing earnings yield, which is the inverse of P. And on the x axis, you are seeing the 2 year forward growth rates. So as you can see, market is today at 24.6 P, and the expected growth is somewhere around 14%. Okay, 14-15% kind of. This is Nifty 500. And then we have put down the other value style, quality, growth, etc. And so typical fund managers in the industry are can be grouped into, one of these. And you can see, for example, quality, the growth rate is very similar to the market, maybe a little bit higher, but it is at 30p. So you are paying pretty expensive. Momentum, the growth rates are higher, maybe around 18% plus, but the P is 40 plus. Small size, small caps, again, micro caps are at about 30p. Growth rate is 17%, but then you're paying too much for it. And the growth is actually not even growing, but it's still at 30%, 30p. And value has very low P, but then the growth also you can see is below even the GDP nominal GDP growth rates. So this is where we think is the optimal portfolio, which is Omni Supernormal, where we are roughly getting the same kind of a 13, 14, 15% kind of growth rates, but at a PE of less than 12. And that is the sweet spot. We think, and many times our portfolio companies, the forecast growth rates are actually conservative. We expect even higher growth rates. As the growth rates come in, the re-rating happens. And we've already shared how the re-rating delivers the major amount of returns. And with the Apple case, I also showed how that low forecast change into high forecast, right? High growth rate forecast eventually. So you just have to analyze it better. So in summary, this is the Omni Supernormal portfolio at 50 lakh ticket size is the starting entry point for our PMS. And for most people, that is the one which is suitable. The Omni Inevitables, we have a large cap, we have a mid cap, we have a small cap, we have mid and small, all those things are there. We have a defense portfolio, we have a railway portfolio under the Inevitables, right? We have a capital creator portfolio. So we have number of portfolios, including debt portfolios for institutions or things which are multi-asset for institutions at 5 crore plus or for family offices. So there are number of things, but do not get confused. Very simple. Omni Supernormal 50 lakhs is the starting point. Most people, that's the PMS you want, and that's the PMS you start off with, assuming that you are a scientific investor. So that's the other thing we mentioned is that you should be a scientific investor who knows that the holding period is 3 to 5 years. Markets go through ups and downs. Once you invest, you should expect to see if you invest 100 rupees, you are willing to see it at 50, 80 rupees, 70 rupees, even 50 rupees. When it goes down, you are willing to put more money. That's the kind of people we are looking for. That's the kind of investors and partners who explain that to their clients. So just let me summarize OmniScience Capital at a glance so that you know us better. So far, we have 100 crores worth of client assets under different licenses, more than 10,000 clients. Practically all the states in India or union territories clients are from there, or and nearly 15 countries. And we have nearly a decade of track record with more than 2 dozen strategies already there. We have a number of licenses. PMS is just the latest edition. We've been doing portfolio advisory services, research analyst, IA. We are on a platform called Small Case, and we are jointly running a Cayman fund. We are advising a Cayman fund. So there are a number of things going on here. And now, disclaimers that past performance is no guarantee of future performance. And secondly, that in equity markets there are risks. So you have to be very careful. And these are we are present on all the social media platforms. And you can check us and on LinkedIn or YouTube, Instagram, Facebook, Twitter, X, everything we are there. And we encourage you to go to our visit our website as well as see us on all these platforms. So, any questions? We are happy to take questions now. You can put the questions in the chat box or the Q&A. So, how many PMS themes? So, as I mentioned, there are three groups. So, there are about 6 to 8 strategies in Omni Crest, which are the things like flexi cap, large cap, mid cap, etc. And under inevitables, there are a number of themes. Right. So we discussed that there are about 8 themes. Documentation is very simple. It's right now it's with paperwork, but within a month it will be all for individual clients. It will be all online as well. So purely digital. Okay. Any other questions?
Yeah, maybe I can just explain because sometimes you might find little overwhelming that there are 28 strategies. Obviously, see, we have seeded all the strategies with proprietary money, as that is one of the principles that we go by, that client come first and then you have to put skin in the game. So across we have put proprietary money in all the strategies that we are launching. But essentially, the asset allocation framework goes like that. You put, your significant, like 50% or more, into Omni Crest, where you are taking specific exposure to maybe large cap, mid cap, small cap, or just a flexi cap allocation, and then you diversify further. Idea is to boost your the potential alpha creation potential for your portfolio, and that can be done like in any particular strategy, like a flexi cap strategy. We're still constrained from just investing in 25 to 35 stocks, while in today's India, as we talked about, that how, when it is like going to a 10 trillion economy, and there are so many exciting opportunities are evolving, whether it is on energy transition, whether it is from financing activities that is happening, or in areas like defense or railways as well. You need more stocks in your portfolio, right? So this is not, just random diversification or buying more stocks. That's not the idea. The idea is that, okay, out of those 1,000 plus companies that are available, can you take structured exposure to various different portfolios, which are all alpha generating? So while flexi cap or any other strategy which is narrow will try to maximize alpha by just focusing on the best of the lot, but the lot itself here is quite broad, and that is the reason that why we want to bring in the inevitables and give option for clients who to if they believe that energy transition is a strong theme and I want to add this to my flexi cap or a foundational core allocation, then that option is here now. So that is the way to approach various product listed under different categories.
So there is some question as to what are the differences between inevitables and or the different themes we have like defense railway and the supernormal flexi cap. So supernormal flexi cap basically will have multiple growth vectors or inevitable themes inside it, right? And that'll keep changing as we find a better set of stocks. The old themes move out, and old stocks representing older themes, and something else will come in. So while when you allocate to, let's say, Omni defense inevitable, then you will continuously have defense related stocks in there. But when you have Omni supernormal flexi cap, sometimes there will be a lot of defense stocks. When that is at a sweet spot, then it will go out and or reduce the exposure, maybe few stocks remaining, and maybe something else is coming in like banks or power companies. So if you just don't want to manage a lot of different strategies, the flexi cap in PMS is the way to go.
So yes, you can have multiple themes in one PMS, while you can start with, let's say, flexi cap, and that's when the paperwork or onboarding happens. Whenever you want to add any other uh, portfolio, the process is then very simple, where you just need to give us the basic go ahead in terms of a subscription form, and then no separate account opening or anything has to happen at that stage. So you can have exposure to multiple themes from OmniScience under the PMS. Ticket size for inevitables is 50 lakhs.
Yeah, I think uh, if there are no more questions, there are more questions. Okay.
Yeah.
Yeah, I think the we've already addressed the minimum ticket size. That is as per SEBI, it has to be 50 lakhs. So yeah, I think people can contact us directly on the contact. I've shared the contact details, right? So you can contact us on the email or um, on the phone numbers, and we can share the specific address, specific questions anyone has, right? So with that, I Ashwini, you want to add anything or we?
No, because I think we can any other questions, we will be happy to take them offline as well. And yeah, that's all from my side as
Perfect. So DMAT will be opened separately for PMS. It is opened under the custodian. Custodian is Orbis Financial Services, which is registered as a custodian with SEBI. So a DMAT account will be opened in that, and it will become an online process from next month. Maybe from January onwards, it will be online process completely for individual clients. But right now, the you have to do a little bit of paperwork. But again, that's not too much. And no, PMS cannot be in anyone's broking account. It has nothing to do with your broking account, your existing accounts. It's completely new account, and that's how it will work. But it's in everything is in your name. Stocks are held in your name, but it is under the management of the custodian. It's under the custody of the custodian, Orbis Financial Services. They will provide you continuously online. You can go and see what is the position of your portfolio, etc. Plus, you get monthly reports, quarterly reports, etc. of what is going on. At the end of year, you also get the capital gains report, etc. Right? Thanks everyone again for attending the session, and we welcome you all to become scientific investors and scientific partners. And thank you all, and thanks Ashwini.
yeah.
And
Thank you,
we
Vikas. Thanks everyone for joining.
Yeah, and we hope to see you becoming scientific investors with OmniScience PMS. Thank you.